Another year, another pile.
Hey, Jason Malabuti here, and I forgot my real estate tax bill hat. That's why I'm wearing my cowboy hat for today. So anyway, let's not get distracted by my hat. Let's talk about depreciation today.
Another year, another pile. Numbers stacked up mile by mile. It's time to sit, reflect, and add. Doing taxes ain't so bad.
How do we calculate depreciation? This is one of the most common mistakes that I see on a tax return. The most common mistake that I see when it comes to depreciation is that people forget to claim depreciation in the first place. So number one is, remember, is that depreciation is not optional. You are required to claim depreciation when you have a rental property. So when you calculate depreciation, first thing is that you need to separate the land because land is not depreciable. One way you figure out how much the value of the land is to, number one, is you can either go to the county records or you can go to the appraisal records of the property. Figure out what's the land value, back that out, and then you depreciate the building value. So for example, let's say you buy a $1 million property, and then let's say you estimate land to be about 20%. So that means that $800,000 of that property is going to be depreciable, right? So land is not always 20%. Sometimes it's less, sometimes it's more. But with that said, 20% is a good placeholder until you confirm with the county records or the appraisal report to determine what is the actual land value. Second thing to note is that long-term rentals and commercial property is depreciated differently. So residential properties is depreciated over 27 and a half years, and commercial is depreciated over 39 years. Here is a trick though. What if you have a short-term rental? Is that residential or is that commercial? Well, for tax purposes, it's going to be commercial, so 39 years. So here's another trick question is, what if you buy the property in December of the previous year, but you don't put it into service until February of the current year? Do you start depreciating during the previous year, or do you start depreciating in the current year? Here is the answer, right? You start depreciating when it's put into service. What does that mean, put into service? It's put into service when it's available for rent. So once you start marketing the property, that's when it is put into service, and you can start depreciating the property, right? So why is this important? It's important because the IRS does not allow you to expense the entire cost of the property in year one. Rather, it allows you to capitalize or depreciate over multiple years. In this case, 27 and a half years for residential and 39 years for commercial. How about capital improvements, right? Like, how about if you fix up the property? Well, when you fix things up in the property, like, for example, you put in new windows, you put in new HVAC, you put up a new fence, you put in flooring. So it really depends. Some of it can be depreciated over 5 years, 7 years, or 15 years. But remember, in 2025, lawmakers revamped the 100% bonus depreciation. So what does that mean? That means that those things that normally you can depreciate over 5, 7, and 15 years, well, now you can depreciate it all in year one, which can lead into having a higher depreciation expense in year one, which in the past you would have to depreciate over multiple years. But when you can claim that larger depreciation in year one, it creates a tax planning opportunity because now you could use that with our bonus depreciation combined with either being a real estate professional or short-term rental loophole or passive loss allowance if you make less than $150,000. Now you could take that passive losses and now you can offset it active income. So let's say you make $200,000, right, with your W-2 income. And let's say you rent a property after you have created a loss from a bonus depreciation, has a $40,000 loss, or now you can offset that $200,000 income. With that $40,000 loss, you can take a $200,000 income and you can offset it with a $40,000 loss. So that is the advantage of using depreciation to your benefit, right? So remember, depreciation is one of the biggest tax benefits in being a real estate investor because It's not an actual expense that comes out of your pocket, but the government gives you that as a deduction to lower your rental income and create a loss, a potential loss to offset other forms of income. So that is what I wanted to talk to you about today regarding depreciation. We're going to be talking more about this during this month's webinar. So make sure that you stay tuned for that. Okay, we're going to be providing a link below to register for this month's webinar where we're going to be talking more about that. Thank you very much.
Stacked up mile by mile, it's time to sit, reflect, and add. Doing taxes ain't so bad.